Hello everyone and welcome to my channel Risk Analytica. So in my previous session, I have discussed on the customer lending cycle or credit life cycle, and I have shared a PPT slides where I have shown you all that what are the pre-approval phases and what are the post-approval phases, how this lending cycle starts and where it ends, and ultimate goal of this lending cycle. So now today we will be discussing on the first stages of the pre-approval phase, which is the customer onboarding and KYC. So the thing is, RM or the global relationship manager or global relationship banker will visit the customers based on their data, and they will meet the customers. And we and if things are okay, then the customer will be onboarded into a bank's database or any financial institution's database. Okay, so how this customer onboarding journey starts and the KYC process happens. So this is the slides. In the next slides, we'll show you that in order to update the customers in the bank's database, the know your customer checks are happen in this way. Suppose if it is an individual whom we are lending money, then what are the documents are required, and in order to lend money to the borrower which are into a company or corporation, then what are the documents are required. So now the KYC checks are conducted to verify the identity of the customer, which also assess the risk associated with the customer and comply with anti-money laundering regulations. Okay, now the national ID card, if it is in India, then we have voter ID card, Aadhaar card. Okay, if it is in US, then social security number, proof of address, passport, driver's license. Okay, so any government issued IDs are required to onboard the customers to verify the legal customers. Now, if it is a business, then employer's identification number, article of association, article of incorporation, corporate resolution, operating agreement, all are required. Then VAT registration, memorandum, and article of associations are required. Okay, and if it is in India, then PAN of the entity, GST registrations are required. Okay, now the verification methods. There are almost 4 to 5 types of verifications methods are available. The first one we have highlighted here is the document verification, which is basically the physical or digital copies of ID proofs and address proof which are examined. Then biometric verification, it can be like fingerprints or facial recognition, which are commonly used in India when like we all have had our Aadhaar card. Now address verification, cross-checking provided addresses with utility bill, okay, like any electricity bill, rental agreement, or any other official document. And finally, it is anti-money laundering screening, which is basically the customers are screened against international and a local sanctions list. Okay, local sanction lists, please note down. There are various types of sanctions happen. It can be a country-wise sanction. Suppose like United States, they have sanctioned Iran and Russia. Okay, both of this country will not export their goods, or they will not do any trade. Okay, and currently there is also a tension between US and China trade war, all sorts of sanctions imposed by a government. Then any politically exposed persons, list or not, any adverse media checks, so all will be initiated. Okay, after that we have credit history check. So there are few independent agencies which are involved in this credit history check. So credit history is basically checks the probability of default, or if the borrower has defaulted in the past. So what are the evidences or the documents? So there must be some agencies who are independently doing this job, okay, to update those customers credit history or any default history status. So there are few agencies like Experian, Equifax, TransUnion. These all are applicable for most of the countries like US, UK, continental Europe, as well as in India. But in India, we have also one more, which is the CIBIL scorecard. We all know that CIBIL scorecard is basically the Credit Information Bureau of India Limited, which is basically for the individual person who are borrowing money from a bank. Then the verification methods. So how these verification methods happen, like if you have any credit reports, then bank will pull that credit reports from these agencies to check for the credit score, okay, or the CIBIL score, then the payment history, existing debts, or any other default or bankruptcy records. Okay, now the second one is the reference check. Reference check sometimes, especially for the large loans, banks may conduct a reference checks with the previous lenders or the financial institutions. So basically, there is a good relationship between all the banks, or they have to report this as a like all the banks, they are aligned, and if one bank is lending huge money to a borrower, then the same request came to another bank, then the new bank, they can take that as a reference, that what was the transaction happen, how the transaction happened, and everything. Okay, after that we have other risk assessment checks. It can be employment checks, any income verification, then bank statement review, debt to income, like what is the debt to income, that means the calculation of uh, debt to income to assess the borrower's ability to manage monthly payment and repay debts. So in order to check this, there are few coverage ratios like debt service coverage ratio, interest service coverage ratio. Is basically that whether the borrower is earning income in a salient way to pay its interest, the due amount of interest, as well as the principal amount. So these all are the ratios are there, and on that basis, that borrower's eligibility or credit worthiness will be calculated. Now, the next one is the collateral verification. Collateral is basically when we are borrowing money from a bank, then we are pledging some assets, or like it is a mortgage, that we are mortgaging some assets in order to avail that loan. So for secured loan, the valuation and the ownership documents of the collateral are also verified. Then the next step is the global reference database, world check. So there is a tool called Refinitiv. So Refinitiv is basically used for anti-money laundering screening to identify high-risk customers. Then Lexis and Nexus. So this is basically provides the risk management and credit history information, and that is particularly used in the United States of America. The next one is Dow Jones Risk and Compliance, which is used for the global sanction list. It can be, which I have mentioned earlier, the government sanction or any company to company sanctions. Okay, then PEP screening and adverse media checks. All these things will be incorporated while the KYC process will be initiated. Okay. Then the ongoing monitoring and compliance, it is basically the periodic KYC updates, which is regular updates of KYC documents to ensure information remains accurate. Then continuous monitoring, regular monitoring of transactions for suspicious activities. Again, by using the anti-money laundering software, which is available in every bank or financial institution or as a whole in the lender. Okay, then the lender use those softwares, AML software. And the finally is the regulatory reporting. Regulator, we all know, like in India, it is RBI as a regulator. In US, it is Security Exchange Commission or the Federal Reserves. Okay, then the reporting any suspicious activities or breaches to the relevant authorities. Then the regulatory framework, how it is. For United States, it is US Patriot Act, Anti-Money Laundering Act, Fair Credit Reporting Act, which is FCRA. These all are the regulatory framework. Like when a bank will lend money to a borrower, if it is a corporation or any individual, then that person or the corporation will screen through this act like US Patriot, Anti-Money Laundering, FCRA Act. If it is in European Union, it is General Data Protection Regulations, Anti-Money Laundering Directives, and the Basel 3 and Basel 3.1. I will take a separate session on Basel. So this is basically banking supervision regulatory authority. They have created this Basel, which is there in the Austria. The capital of Austria is Vienna, where these Basel institutions are located and they are situated. And they basically impose rules and regulations to all the bank and the financial institutions. Okay. Now in India, it is Prevention of Money Laundering Act, RBI guidelines, SEBI regulations. So these all are the regulatory framework. So in the conclusion, these steps form the fundamental process before lending money to a borrower and also ensuring that the borrower is reliable and compliant with local and international regulations. Okay. And that the bank's risk is minimized. That should be the basic fundamental of a lending institution. That if I am lending money to a suspicious person, then definitely that amount will be defaulted and bank will suffer huge amount of NPA if the transaction is huge. Okay, so we have to take care of this credit risk. Then we can also say that the process is just a combination of rigorous documentation. You all have gone through these entire slides and you could understand that what are the different phases of documentations are happened, as well as the verification and continuous monitoring process also happen. And finally, we should abide by the regulators and adhere to regulatory standards. Okay, so once these steps are completed, then the customer will be successfully onboarded into a bank's database, and then the lending process will happen. And it is not that once we have onboarded the customer, our job is done. No, we have to monitor that. And we also have to update the latest database. So that's it for the KYC process. In my next session, I will discuss on the second phase of pre-approval department, which is financial spreading. What is spreading? What is the requirement of spreading? And how this is very critical for a bank or financial institution to lend money, we will discuss. Thank you. Take care, everyone. Bye.